You have a flair for writing memos. And in your latest memo, you do what few people have the courage to do, particularly at a time when everyone's making so much money in financial markets. You've sounded a warning. Why?
Well, first of all, Eric, the time to sound the warning is when everybody's making a lot of money, because that means the market's going up, up, up. Enthusiasm is incorporated in prices and behavior. And, you know, you can't sound a warning after the thing has turned over and died. I think that we see a market in which there are lots of uncertainties, prospective returns are low, asset prices are high, and people are engaging in risky behavior. And that is the kind of climate in which we should take a hard look at what we're doing and, I think, reduce risk.
There are lots of people who want to keep making money. What kind of pushback have you gotten?
Well, here's a shocker for you, Eric. I want to keep making money too, but I try not to deceive myself about the ability to do that. This memo has gotten some of the most response of any in history, and I would say 90-odd% favorable, but some strong unfavorables.
And what do those people have to say?
Well, one of them, who I've seen on TV this morning, says, Howard Marks says it's time to get out. I absolutely do not say it's time to get out. I don't say anything about getting out. I say it's a time for caution. One of them said, now is no better time for caution than any other time. And in fact, there is no better time for cash or for hedges, et cetera, and no worse time that we can perceive. In other words, it's impossible to correctly put risk on or take risk off. We should always act as if we don't know.
That sounds like a recipe for disaster.
Well, not for disaster, but I would say for merely mortal performance. I think if you want to perform at an above-average level, one of the things you have to do is, to use your parlance, put risk on at some point in time and take it off at some point in time, rather than be consistent in that regard. There are better and worse times for aggressiveness and for conservatism.
So let's touch on that point for a moment. You have rung the alarm bell before.
Yes.
In 2000.
Yes.
A very timely ringing of the bell. In 2005, which, as you yourself have acknowledged, was a bit early.
Right.
Does the need to reduce risk feel any more urgent to you now than it did then?
Well, I thought that, in 2000, my comment was not about the stock market, it was about the tech stocks. Mm-hmm. And I thought that was much more urgent than today. I mean, they really looked offbeat in those days. In 2005, it wasn't quite so urgent, but then, of course, the market had another 2 years to run, at which time it became urgent. So, I wouldn't describe it as urgent today. The economy is still clipping along at a modest pace and likely to do so. There has not been an economic boom, so I don't think there has to be an economic bust, and certainly not anytime soon. I'm merely commenting, so I'm not really commenting so much on the fundamentals. I'm commenting on investor behavior and asset prices.
Okay, so many of the conditions that you describe in your memo are reflective or indicative
Yes.
of an overheated market,
Yes.
or at least a market that is on its way to being overheated. Among them, right, rich valuations, low volatility, super stocks like the FAANGs, the popularity of ETFs, the reach for yield. Those conditions, Howard, have been in place for months, if not quarters, if not years. So what changed? Why now?
Eric, there's no magic. It's just the accumulation of things. I once read where a journalist said, "I gather string." I gather string. I gather anecdotes about high valuations and about behavior. My son Andrew brings these things to my attention, and we talk about them. And I think just enough accumulated.
So it's a gut feeling?
Yes, there's no magic. There's no quantitativeness.
Does anything in particular, Howard, strike you as most vulnerable or most dangerous right now?
Absolutely not, Eric. I think it's evenly spread about. The main cause for all of this is uniform and applies to everything, and that is the low level of interest rates. Low interest rates cause for inflated valuations of everything, and by being so unappealing to investors on safe instruments, they push everybody out the yield curve to do risky things. The real question is, how do you make a good return in a low return world?
Okay,
Really?
so how do you do that?
Well,
what out there offers the appropriate mix of risk and reward right now?
there is no magic. There is no magic
Well, there
solution.
has to be something.
Well, no.
I mean, let me float a few ideas.
Yes.
Right? Credit spreads are awfully tight.
Yes.
You might say that things are getting expensive in the high yield market.
Yes.
Is an investor better off today, safer, buying an investment grade bond than a high yield bond? Or is he better off buying treasuries or agencies?
Well, I mean, that's the dilemma, and that's why there's no easy answer today. You're safer buying a treasury that yields 1 or 2, but high yield yields 5 or 6, and you may have to wait a few years before the treasury turns out to have been the right thing to do, in which case you passed by 8, 12 points of yield.
I know it's not easy,
Right.
but the reason people are watching us having this conversation is because they too are struggling, trying to figure out what to do. So let's give them a few ideas.
Okay, the only thing I'm confident about, Eric, is that within every strategy and market niche, whether it's high yield or emerging market debt or equities, there are riskier and less risky things to do. And at this point, I would be moving toward the less risky. Somebody said on TV recently about me, it's time to get out. I don't say it's time to get out. But
And many investors can't. They have to be invested.
Exactly. And somebody said, there are no better and worse times for caution. But I don't agree with that.
You don't agree?
There are better times for caution, and this is one. So you should be moving in the... Investing is not black or white, in or out, risky or safe. When behavior is risky and prices are high and the market has been doing well for a long time, it's time to be shifting your portfolio in the direction of caution.
Is that what Oaktree is doing?
Yes, yes, we are fully invested in every currently investing vehicle, but we are applying an unusually high level of caution, and we consider ourselves cautious investors, and we are doing more than usual.
Will Oaktree investors have the patience, Howard, for underperformance if your warning and the caution that results from it proves to be too early?
Well, Eric, that's a great question. I believe so. You know why? Because when they sign on, we tell them if the market cooks and you get into a climate where the people who take the most risk are making the most money, it won't be us. And our clients are intelligent clients, and they self-select. The ones who come to us are the ones who say, I don't necessarily want to make the whole return on the market when it does well. I want to be protected in the bad times.
Howard, at one point in this memo, you call the fee structure around SoftBank's Vision Fund, $100 billion Vision Fund, questionable.
Yes.
Is that fair?
Well, it's not really the fee structure, it's the capital structure. If you want to put $100 into that fund, 62 of it has to go into debt and 38 into equity. So you only, if they make good tech investments and produce a high return, you only get that high return on 38% of your money.
Okay.
But I think you're taking substantial risk on all your money. I don't know their portfolio. I don't know what they're going to do. I don't know the
Well, one of the
specifics.
things they might do is buy Charter for $65 billion.
Yes. And
Is that a wise use of capital?
I don't know the situation well enough, and I would never say on your show whether it is or not. But the point is, you have upside on 38. I believe you have downside on more than 38. So the calculus is weighted against you.
If you were to look at every capital and fee structure on every Oaktree fund that has ever existed, could you say with confidence that none of them in retrospect was ever questionable?
Well, you know, we get, on our closed-end funds, we get 20% of the profits. But we have a hurdle rate. We have to make 8% before we come in for our 20%. The clients have to make 8% net of fees. So I think it's fair to them. You know, you can look, incentive fees, carried interest, has been the story of the investment business in the last 30 years. You can always complain about it. You can say, well, is it fair to get carried interest, and should it be 20 as opposed to 15 or 30? But I don't think it's unfair, as long as, number one, you get paid on multi-year performance, not 1 year, and number two, there's a hurdle rate.
What about the FAANG stocks? They too merit special mention in your memo.
Yes.
And it appears that you have some concerns about the momentum behind the FAANG stocks, the amount of money that people are pouring into them. If we were to measure them on the basis of valuation, and we use the price to forward earnings,
right,
the valuation's been coming down for most of those stocks.
Well, they're doing the ones that have earnings are doing well earnings-wise, so the valuations are coming down. I think they're still high. I think they still embody a lot of optimism. Erik, my point about the FAANGs was not that they are bad investments individually or that they're overvalued. It was that the anointment of one group of super stocks is indicative of a bull market. You can't have a group treated like the FAANGs have been treated in a cautious, pessimistic, sober market. That should not be read as a complaint about that group, but rather indicative.
Of all the things you highlight in the memo,
yes,
we've covered a number of them. The
yes,
FAANG stocks, the Vision Fund, ETFs, emerging market debt, skinny spreads and credit. Single out one for me. What's the one that concerns you the most?
I'm going to single out two, although that's probably an oxymoron when you use the word single. Netflix bonds at 3 5/8%. You know, you go to a video store, you rent a video, some of the videos give you a choice of an ending. Which is the good ending for that bond? The best ending is you make 3 5/8%. How good is that at a time when high yield bonds pay 5.5%? This is a company that chews up capital. And when you buy a straight bond, the coupon is the best you can do. All the other endings are worse. So I think the fact that people will buy a 3 5/8% bond from as growthy a company as Netflix is one, and the other, of course, is the fact that Argentina, emerging from bankruptcy, can issue 100-year bonds. They've had 5 devaluations in the last 100 years. What's the chance they get through the next 500 years without a devaluation, debt repudiation, coup, or scandal? So it's all about investors' willingness to take risk as opposed to insisting on safety. And when people are highly willing to take risk and not concerned about safety, that's when I get worried.